Welcome back to XGen Investor. I'm your host, Jake James Vogel. Sometimes the market hands us gifts at exactly the right moment. Today, for me, that gift is General Mills, a company that is historically cheap, incredibly stable, and packed with brands we all know and trust. And the truth is, when you see a stock like this trading near its lows, it's hard not to take notice. General Mills quietly dominates the grocery aisles. Think Cheerios and Wheaties in the cereal section, Nature Valley bars for a quick snack, Betty Crocker mixes for baking, Pillsbury doughs and Bisquick, Yoplait yogurt, Old El Paso in the Mexican food section, and even Blue Buffalo for your pets. These aren't just products, they're staples, cash flow engines, and part of what makes General Mills a defensive powerhouse. Pause and consider that almost every American household interacts with these brands regularly. That's real stability built into the business. Right now, General Mills trades around $48 to $49 a share, near its 52-week low. Its price to earnings ratio sits just over 9, well below its 10-year average and far under sector norms. For investors, that's a glaring undervaluation. The stock has seen a rough stretch recently, down about 28% in the past year, largely due to soft sales and inventory corrections. But the fundamentals remain strong. Revenue for this year is $19 billion. It employs about 33,000 people worldwide and continues to generate predictable earnings from its massive portfolio of trusted brands. Food is essential. People eat no matter what's happening in the economy. General Mills is a perfect example of a defensive play. In the stagflation of the 1970s, food producers held up far better than most sectors, and General Mills carries that same resilience today. Its strong brands give it pricing power, letting it pass some inflation on to consumers. Its cash flows cover debt comfortably. The dividend sits over 5%, and its operations spans cereals, snacks, baking products, yogurts, international foods, and pet nutrition. A broad safety net against market swings. Speaking of debt, General Mills carries roughly $13 to $14 billion in debt, mostly from strategic acquisitions like Blue Buffalo and ongoing share buybacks. That might sound concerning at first, but it's deliberate. Interest coverage is strong, the debt is largely long-term and fixed, and the company's predictable cash flow makes it entirely manageable. Debt has allowed General Mills to expand its product portfolio, modernize operations, and return capital to shareholders without diluting equity. That's exactly the kind of disciplined strategy you want to see in a large, stable company. Inventory is another strength. With over $2 billion in inventory, General Mills can handle supply chain disruptions or commodity price swings without missing a beat. Unlike some competitors that rely heavily on raw commodity speculation, General Mills sources ingredients like soy oil, lectin, and other raw materials from processors such as ADM and Cargill, allowing it to focus on production, brands, and consumers rather than speculating on raw commodities. General Mills isn't a high-growth story. It won't make headlines with explosive earnings or flashy acquisitions, but that's the point. Its value lies in stability, brand equity, and defensive characteristics that shine when markets get turbulent. Low valuation, high dividend yield, and strong and diversified brands, predictable cash flows, and strategic debt management make it one of the most compelling defensive plays out there right now. At its current price, near 52-week lows, and trading at a PE far below sector norms, General Mills is a classic case where market's short-term worries have created a long-term opportunity. Its brands, Cheerios, Wheaties, Nature Valley, Betty Crocker, Pillsbury, Bisquick, Yoplait, Old El Paso and Blue Buffalo aren't just products on the shelf, they're cash flow engines. For investors looking for income, stability, and a defensive anchor, General Mills is a gift the market is handing out right now. The only cereal my daughter will eat is Lucky Charms. If Peter Lynch were me, he would buy General Mills stocks at its current market cap. I'm not Peter Lynch, but I'd love to learn from his success. Again, as always, this is not financial advice. I own General Mills as of today, and this script reflects my personal view of the company as an undervalued defensive stock. Always do your own research before making investment decisions and speak to a licensed financial professional if you deem it necessary. But always, again, do your own research because all investments come with the risk of loss. Take care.